In 2008, the banks of one small country owed roughly 10 times more money than that entire country's economy was worth in a year. Not 10% more. 10 times more. To put that in perspective, imagine your household owing 10 times your entire annual income, not to one bank, but effectively to the whole world. That's roughly the position Iceland found itself in, almost overnight. This is the story of how one of the smallest, most stable countries in the world built the largest banking collapse, relative to its size, in modern history. To understand how this happened, you need to understand just how small Iceland actually is. In 2008, its entire population was around 320,000 people, smaller than many single American cities. For most of its modern history, Iceland's economy revolved around fishing and, more recently, aluminum production and tourism, solid, steady, unglamorous industries. But in the early 2000s, the Icelandic government pursued an aggressive strategy of financial deregulation, privatizing its major banks and encouraging them to expand rapidly, both domestically and internationally. Three banks in particular, Kaupthing, Landsbanki, and Glitnir, took this opportunity and ran with it, expanding at an almost unbelievable pace, aggressively acquiring assets abroad and offering extremely attractive savings account interest rates to attract deposits from customers well outside Iceland, particularly in the UK and the Netherlands. Within just a few years, these three banks had grown to hold combined assets worth roughly 10 times the size of Iceland's entire gross domestic product. Here's the part that made this situation so dangerous. Iceland's tiny central bank and financial regulators simply didn't have the resources or authority to properly oversee institutions that had grown this large, this fast. These banks had effectively outgrown the ability of their own home country to act as a meaningful safety net if something went wrong. If a bank this large in a country this small ever failed, there was no realistic way the Icelandic government could bail it out the way, say, the US government could support its own much larger banks. Attractive savings accounts offered by these banks, particularly one called Icesave, operated by Landsbanki, pulled in hundreds of thousands of foreign depositors from the UK and Netherlands, drawn in by interest rates significantly higher than what local banks in their own countries were offering. By 2007 and into 2008, global financial markets were already becoming increasingly unstable, as the broader global financial crisis began unfolding in the United States and spreading internationally. Iceland's banks, having borrowed enormous amounts of short-term funding to finance their rapid international expansion, were suddenly extremely exposed. As global credit markets tightened dramatically in 2008, Iceland's banks found themselves in an impossible position. They had built their rapid growth on borrowed money that needed to be constantly refinanced, essentially rolling over debt continuously to keep operating. When international credit markets froze up during the broader 2008 financial crisis, these Icelandic banks suddenly couldn't access the funding they depended on to survive. In early October 2008, within just a few extraordinary days, all three of Iceland's major banks collapsed. The Icelandic government, recognizing it had no realistic ability to bail out institutions 10 times larger than the entire national economy, made the unprecedented decision to let them fail, rather than attempt an impossible rescue. The Icelandic krona, the national currency, lost a huge portion of its value almost overnight, as international confidence in the entire Icelandic economy evaporated. Ordinary Icelandic citizens who had taken out loans, particularly mortgages linked to foreign currencies, which had seemed like a smart, lower-interest option during the boom years, suddenly found their debt burden skyrocketing in real terms, even as their own wages and the krona's value collapsed around them. Meanwhile, roughly 400,000 foreign depositors in the UK and Netherlands, more than Iceland's entire population, suddenly found their Icesave savings frozen, triggering a major international diplomatic and legal dispute over who was actually responsible for repaying them. What happened next made Iceland's collapse genuinely unique among major financial crises, because unlike most countries facing this situation, Iceland made some deeply unconventional choices. Rather than bailing out the bank's foreign creditors and shareholders, the standard approach many larger countries took during the broader 2008 financial crisis, Iceland let those banks fail completely, protecting domestic depositors while foreign bondholders and shareholders absorbed massive losses. Iceland also imposed strict capital controls, temporarily restricting how much money could flow in and out of the country, to stabilize its currency and financial system. Perhaps most notably, Iceland pursued criminal prosecutions against several bank executives, ultimately convicting a number of them for fraud and market manipulation related to the collapse, a strikingly different outcome compared to most countries affected by the broader 2008 financial crisis, where very few senior bank executives faced any criminal consequences at all. Remarkably, within just a few years, Iceland's economy began recovering, aided significantly by a rebound in tourism and a currency that, while devalued, made Icelandic exports and travel significantly more attractive internationally. It's a recovery that many economists still study today as an unusual counterexample to the standard playbook most countries followed after 2008. Here's what makes Iceland's collapse worth remembering: this wasn't just a story about banks growing too large. It's one of the clearest real-world examples of what happens when a country's financial sector significantly outgrows its ability to actually protect itself. And it raises a genuinely interesting question: was letting the banks fail, and prosecuting the executives responsible, actually the smarter long-term strategy, compared to the massive bailouts most larger countries pursued during the same crisis? So here's what I want to know: do you think other countries should have followed Iceland's approach in 2008, letting failing banks collapse and holding executives criminally accountable, instead of bailing them out? Tell me your take in the comments. This is a debate that still divides economists today. If you find these smaller, often overlooked financial crises just as compelling as the massive, well-known ones, subscribe, because this channel is built around finding exactly these underexplored stories. And if you want to see what happens when an entire chain reaction of currency collapses spreads across multiple countries at once, rather than staying contained to just one, you'll find this one interesting. It's on my channel about the 1997 Asian financial crisis. Thanks for watching. Which part of this surprised you the most? Let me know below, and if you want more forgotten history like this, subscribe, there's a lot more coming.